The Chapter 15 Exam Review. Before we get to any questions, we're going to look at the big picture with Saul in this chapter. First topic will be the budgeting chapter part, and the basic idea here is that there are two kinds of budgets, static budget and a flexible budget. A static budget, there's no adjustment for actual level of production. In a flexible budget, the budget can be adjusted to various activity levels. So which is the best use in a performance analysis? That's what we're going to try to find out here. And the answer is a flexible budget, because in a static budget, you're always taking the chance of comparing apples to oranges. Okay, our first question. XYZ's static budget is based on a planned activity level of 37,000 units. At the same time the static budget was prepared, the management accountant prepared two additional budgets, one based on 32,000 units and one based on 42,000 units. The companies actually produced and sold 41,000 units. So in evaluating its performance, management should compare the company's actual revenues and costs to a budget based on how many units? Well, the answer here is actual results based on actual volume of activity. That's what you should always make your comparisons to. So in this case, that's going to be 41,000 units because that's what you actually produced and sold. So you should put together a flexible budget based on standard cost at this activity level, which is 41,000 units. Second question. XYZ company developed the following static budget at the beginning of the company's accounting period. They had revenues based on 10,400 units, and that's a total of $20,800. Variable costs were a total of $5,200. Contribution margin was $15,600, fixed cost $5,200, and net income would be $10,400. If actual production totals 10,800 units, the flexible budget would show total costs of what? This is an interesting question because they don't want to know net income. They want to know what total cost would be if you switch the volume to 10,800 units. So we don't want to, compare apples to oranges. We want to have a fair comparison here. So if we start with what we had as a static budget, which is based on 10,400 units, our total cost would be two kinds. Variable cost of $5,200, and that $5,200, it's an important calculation to make next, which would be, what's that come out to be per unit? Well, it's $5,200 divided by 10,400 units. That's what we were budgeting for, which is 50 cents per unit variable cost. And then our fixed costs are going to be $5,200. So our total cost that we have in the static budget is going to be the sum of those two, which is $10,400. Now let's see what the total cost would be under 10,800 units. So 10,800 units, variable cost will be $5,400, not $5,200, but $5,400. And how do we get that? Very important calculation. We take the 50 cent per unit variable cost that we figured here and just multiply it times the new level of volume, which in this case was 10,800 units. That gives us $5,400. Next, most important concept here is that fixed cost, whether we operate at 10,800 units or 10,400 units, the fixed costs are going to be the same, which is going to be $5,200. So total cost under the new actual level of units that we actually produced, 10,800, is going to give us a total cost of $10,600. Next question. XYZ company developed a static budget at the beginning of the company's accounting period based on an expected volume of 5,000 units. Here is our per unit volume information. The revenue would be based on a selling price of $7. Variable cost, $2.50 per unit. Contribution margin is the difference between 7 and 250, which is $4.50. Fixed cost are $3 per unit, and then net income is $1.50 per unit. If actual totals production, that is, if actual production totals 6,000 units, and that's within the relevant range, that's a very important sentence piece right there. If we have 6,000 units and we're still within the relevant range, that means that's a very important thing to keep in mind, because the flexible budget would show a fixed cost of what? Well, if it's within the relevant range, fixed costs don't change. So we can come out with a calculation for fixed cost in total, and that total fixed cost will equal what it would be at 5,000 or at 6,000. So total fixed cost will be based on 5,000 units originally, which would be 5,000 times $3 per unit, which would be $15,000. And if it's $15,000 total fixed cost at 5,000 units, that's what it's going to be at 6,000 units, because it's within the relevant range. So the amount is unchanged if the flexible budget is prepared at a level of 6,000 units. So that's what the answer is. And if you're a little rusty on what relevant range means, it means that if we are a pizza company like Pizza Hut, and Pizza Hut ovens are $15,000 a piece, well, if we have one oven, which is $15,000, that oven will produce all the way from 0 all the way up to 10,000 pizzas an hour. Now, if we operate at 5,000 units per hour, that's within the relevant range, which is right here in the middle of it. And if we operate at 6,000 units, that's still within the relevant range for this one oven. If we operated at anything other than that, like a higher number, like 12,000 or 15,000, we'd have to buy a second oven. And then our fixed cost wouldn't be 15,000, which is the oven cost, it'd be 30,000, and so on and so forth. And if our fixed costs got higher than 20,000, if we operated a volume that was more than 20,000 units, then we'd have to buy another oven, which now we have 3 ovens, and that third oven, altogether, all 3 ovens would cost us $45,000, but we could operate then, we could make anywhere from 20 to 30,000 pizzas. But the moral of the story is we are only operating at, in this case, originally 5,000 units, which is one oven. And if we jump up to 6,000 units, we're still only using that one oven, so our relevant range doesn't change, our fixed costs don't change, and that's the answer. So the answer is 15,000. Next question. We have a static budget, and it's based on sales with a selling price of $70, total sales of $840,000. That's our static numbers. We have variable cost of manufacturing cost of $30 per unit. Total there would be $360,000. Selling and administrative expenses, they're $20 per unit. Total of $190. Contribution margin is going to be $20. That would be the $50 here of variable cost subtracted from the $70, which gives us a $20 contribution margin per unit. Total contribution margin with this static budget is $290,000. Then we have fixed cost, manufacturing costs that are fixed of $78,000. Selling and administrative costs that are fixed of $127,000. Total fixed costs are $205,000. Net income, which will be the contribution margin minus the total fixed cost, will be $85,000. So, what will be the overall volume variance? And what they're really saying here is what's overall net income if 15,000 units are produced and sold, as opposed to what we are currently doing right now. So the first thing we've got to do is figure out what is the current volume we're operating at. So the way to figure that out is take the total sales, divide that by the selling price per unit, and right now this budget is based on 12,000 units. So what's going to be our net income, or they state it this way, overall volume variance? What's going to be the overall volume variance if we are going to operate at 15,000 units? Well, let's do that. So if we operate at 15,000 units, we're going to look at what the static budget number was, which are these pieces right here, and compare that to the flexible budget, right? And so we're going to say originally, sales were 840,000, and now sales are going to be 1,050,000, and that's based on doing the following thing. We're going to take our original selling price and multiply it times, not times 12,000, but times 15,000. So 70 times 15,000 gives us a total sales at this new flexible budget number of $1,050,000. And you can see that when you compare the static budget amount to the flexible budget amount, we get a volume variance, and that volume variance is positive or favorable by $210,000. But let's go on. So again, we're operating at 15,000 units with this new flexible budget. So let's crank in these other pieces here. So our variable manufacturing costs were $360. Now they're going to be $450. And the way you get to $450, 30 times 15,000 is $450. And in this situation, when you compare the static number to the flexible budget number, it's a $90,000 difference. And since the costs are higher, and you'd expect them to be higher, right, because we're operating at more units, that means this volume variance is a negative or an unfavorable variance. Variable and selling administrative cost, which would be right here, they're $20 per unit. Multiply that times 15,000 units, and you will get $300,000 as the total cost there. Comparing that to the static budget amount of $190, and we have a $10,000 volume variance, and it's unfavorable. Now our contribution margin will just simply be sales minus these two variable costs combined together to get, originally it was $290, now it's going to be $300,000. And when you compare these two pieces, if contribution margin is higher, and which it is in this flexible budget, it's a $10,000 higher number, so that means it's going to be a favorable variance. The fixed costs are going to be the same, at least they start off being the same, $78,000 on the static budget, and since we're still within the relevant range here, going from 12,000 to 15,000, then that's going to be, you have to assume we're in the relevant range unless it tells you otherwise. So we're in the relevant range, so there's no volume variance. And then the same thing for the fixed selling and administrative expenses. Same thing here, and no variance there. And then so the net income difference, or the total volume variance difference, is going to be, the static budget was 85, the flexible budget is 95, which means we have $10,000 more income, and that's a favorable situation. Next problem. We have a static budget of 25,000 units, and here's what our sales are, 300,000. Our manufacturing costs that are variable are 87.5. Variable selling administrative expenses are 65,000. Contribution margin is 147.5. That's these two numbers subtracted from 300,000. Our fixed expenses are going to be manufacturing costs of 32.5, selling expenses and administrative expenses of 16,250. These two things are added together, subtracted from contribution margin to get net income of 98,750. And they want to know, what will budgeted net income equal if 23,000 units are produced and sold? So in this situation, we're going to go down 2,000 units. We were, under the static budget, planning on making and selling 25,000 units, but we only sold 23,000 units. So let's plug in the numbers that relate to same as the last problem, except this time our volume is going down instead of going up. So at 23,000 units, our flexible budget number for sales will be 300,000 divided by 25,000 units to get a selling price per unit, which is $12. We'll multiply that times 23,000 units, our new volume level, and we'll get $276,000 in sales. Our variable manufacturing costs are going to be, they were 65,000 based on 25,000 units. Now they're going to be based on 23,000 units. So the variable the variable manufacturing expenses per unit are going to be 87,500 divided by 25,000 units, which is $3.50 per unit. Multiply that times 23,000 units, and you get the new variable manufacturing cost based on the new volume level, and that'll be $80,500. Same thing to the variable selling and administrative expenses. You'll take the original number with 65,000, and you'll divide that into, or by 25,000 units. You get $2.60 per unit times the new volume level of 23,000 units. You get $59,800. Contribution margin, these two pieces together, add together, subtract from the sales, you get a 135.7. Fixed manufacturing costs are fixed, whether it's 25,000 or 23,000. So it's 32.5 for the fixed manufacturing. Fixed selling administrative are 16,250. Net income is 86,950. That's the answer we're looking for if you change the volume to 23,000 units. Next, let's change the topic and go to standard costing. The purpose of standard costing, basically in a nutshell, is to improve quality and so that management has no surprises. So let's look at our first problem here. We have a company called XYZ, and this is their standard cost card for this product A. This is what we think we should be making things at our standard cost for these different pieces. So the standards say that we should use 3 pounds of direct material at $4 a pound, or $12 in terms of dollars worth of material for each unit we make. The standards say that we should use direct labor 2 hours, $6 per hour, total of $12. Our variable overhead should be 1 hour at $2 per hour, which is called total $2. Our fixed overhead should be 1 hour at $3 per hour, or $3 altogether. And the total standard cost of a unit should be $29 when you add all these together. It says here that the fixed overhead rate is based on total budgeted fixed overhead of $13,000. During the period, the company produced and sold 5,200 units at the following cost. So they actually produced and sold 5,200 units, and their actual cost for direct labor was 13,000 pounds at $3.50 a pound. Their actual direct labor costs were 4,950 hours at $12 per hour, and their actual overhead was $29,960. Now, they've already told us that the standard manufacturing cost per unit is $29. That was up here, right? So what they want to know is, what is the actual manufacturing cost per unit? So we're not supposed to round intermediate calculations. We're supposed to round final calculations to 2 decimal places. So let's see what the actual manufacturing costs per unit are. So we're going to use a lot of these actual numbers here. And this, of course, this actual units we produced. So let's do this. Actual manufacturing costs are going to equal the actual direct material cost plus the actual direct labor cost plus the actual overhead cost. And all those actual manufacturing costs are then going to be as follows. 13,000 pounds of material at $3.50 a pound, plus 4,950 hours of labor at $12 per hour, another actual number, and overhead, which was $29,960. You want to add those things together and get a total of $134,860. And then to get the actual cost per unit, you're going to take the $134,860 and divide it by the number we actually made, which was 5,200 units. So the answer here is going to be $25.93 is the actual manufacturing cost per unit. Now, let's take a look at a topic that is for the rest of the exam questions, which will be return on investment. The return on investment formula is operating income divided by operating assets. That'll give you the return on investment. This number is always expressed as a percentage, okay? Now, sometimes it's necessary to break this return on investment into two separate pieces. Operating income divided by sales, and that has a name. That's called margin or net margin. And then you multiply that times sales divided by operating assets, and this has a name, and this is called turnover. So another way, or you might say an expanded way to look at return on investment would be to say margin, net margin times turnover. And let me give you that. Profit margin, which is how much each dollar in the revenue collected by the company translates into profit. And this profit margin is always expressed as a percentage. And like I said, sales divided by operating assets, that's something called asset turnover. And here what you're saying is, how many sales could I generate by the number of assets that I had to use or to work with? So, like I said, the original return on investment calculation or formula is operating income divided by operating assets. But like I said, sometimes it's necessary to break this into a little bit more pieces, which would be saying profit margin times asset turnover. Now, let's, and again, this asset turnover tries to measure how efficient the company is in using its assets to generate revenue. Profit margin, again, is expressed as a percentage, and higher is better. Asset turnover is expressed as just a number, like 1.3, 2.4, whatever, and that number, higher is better here. So I believe we got 3 exam questions that are based on this return on investment, either the abbreviated formula or the expanded formula. Here's our first question. XYZ company reported the following information for the current year. We have sales, $920,000, average operating assets, $620,000, and our margin, profit margin, that's short for profit margin, is 10%. The company's return on investment was how much? Okay, well, we have like I said, two things to look at here. We've got the original return on investment formula, or you've got what I'll call the expanded formula, which breaks it into 2 other pieces here. So let's see how much of this given information we can plug into things, and let's see which one of these 2 formulas we should try to use. Well, sales, that's a number that fits better down here in this expanded formula, and average operating assets, that would fit right here, so that's a piece we could put right there. Margin is 10%, and that's, again, the profit margin. It fits better right here. So if we're looking for return on investment, and using this, let's just pretend we're using this formula right here, the top one, the original formula, the short version. We've got operating assets, which is the denominator right here, but we don't have operating income. And so if we don't have this piece, operating income, and of course we're looking for return on investment, we've only got one of the 3 pieces right here. And so it's probably better off for us to come down here and use this more expanded formula, because we just don't have enough pieces to find this unknown. So let's go down here and use this more of an expanded formula. All right, so which formula should we use? Probably the expanded one. So we're going to say that the operating income, up there, right there, divided by the sales times the $920,000 worth of, again, sales. Because we had sales in both these things, so we can plug in sales right here on the bottom of this one, and we can plug in sales right here as the numerator for this formula, divided by $620,000 worth of operating assets. So we're getting closer. So the only thing we have unknown here is this operating income, which we can figure out. Or we can say this, operating income divided by sales, there's another term for that. That's another formula called profit margin. And they gave us profit margin. So we can say profit margin times this asset turnover. and I've already made the calculation. So if you take $920,000 in sales divided by $620,000 in operating assets, you get an asset turnover of 1.484. So now we're getting awful close to the answer here. So we can say the return on investment is equal to the margin, or profit margin, however you want to say. I'm just saying margin here because I don't want to confuse you with what they have over here. Margin times 1.484. All right. And so the margin was 10%. So let me plug that into the next bottom, the next thing. So 10%, that was what the margin was given to us. 10% times 1.414 is equal to 0.1483. Now, if you move your decimal place over 2 places to the right, then you'll come out with, and by the way, I just rounded this off and it rounds off to 14.84%. Okay. Oh, that's a typo there. Excuse me. Whenever you take 10% times 1.8484, you get 0.1484. I'm so sorry. That's my error right there. And anyway, so you move your decimal place 2 places over to the right, and you'll turn this into a percentage, which is 14.84%. So the answer here we're looking for is let's see here. We're looking for return on investment. So the return on investment is 14.84%. And again, you had to use, or at least I used, this more of expanded formula. And I knew my profit margin, which was 10%, right? I kind of slowly did a couple of extra pieces right in the steps, but I knew my profit margin. And I also could figure out my asset turnover because I had enough information. I had the sales and I had operating assets. So anyway, that's the answer. And let's go on to the second return on investment question. And like I said, don't forget to move those 2 decimal places over to the right because your calculator is going to come up with 0.1484. Next question. XYZ Corporation desires a 10% return on investment on all operations, and the following information was available for the company during the current year. They gave us sales number, they gave us operating income, which is $4,500, and they gave us turnover, and that's asset turnover, which is this piece right here, of 0.5. So what is the company's return on investment? So let's see which one of these 2 formulas we should try to use. Here, we've got operating income right there, but we don't have operating assets. So probably the best one to use would be something that is this more expanded view of this. So let's plug in the things that we know here. So operating income was $4,500. We're going to start right here. Operating income was $4,500. Sales were $19,000. So we'll plug that in. And so that is the calculation for profit margin, right? And then they gave us turnover, so we don't have to know anything about, well, we know the sales, but if we don't know operating assets, we know that these 2 pieces together, when you take operating assets and divide them into sales, you get asset turnover, and they gave us turnover. So we're going to use that 0.5 right here as turnover. So 19,000 divided by operating asset, and again, I just went ahead and went through the steps to make sure you knew that we just don't have enough information for this, but we do have turnover, so we're going to use turnover here. So our next line down, we're going to say the 4,500. Oh, by the way, I'm going to go through this first. The 4,500 divided by 19,000, which is the first piece of this, which is profit margin, is going to turn out in your calculator to be 0.2368. Put the 2 decimal places 2 more to the right, and this turns into a percentage, which is what it should be expressed as, 23.68%. So now you've got the profit margin piece, and you also have the turnover piece, right? So 23.68% times this, which you don't have enough information to solve that, but they told you turnover, so you've got turnover of 0.5. So multiplying 23.68% times 0.5 will give you the answer, and the answer is 11.84%. So that's the second return on investment question. Let's take a look at the last one. The last one says XYZ company has an investment in assets of $1,116,000. They've got operating income that is 10% of sales, and they have a return on investments that's 18%. So, from this information, the amount of operating income should be what? Okay, so this one deals with this equation right here. This more original formula, which is return on investment is equal to the operating income divided by operating assets. Because we've got two of these three pieces, so we can solve. We don't even have to use this expanded formula over here. So return on investment of 18%. So we've got the return on investment number already. 18% is equal to the operating income, which is what we're looking for. That's the unknown, divided by operating assets. And we have operating assets, which are $1,116,000. So let's go on down the next line and plug in the things that we know. Return on assets of 18% equals operating income divided by $1,116,000. So now we're going to do something that some of us may have remember from an old math class. We're going to do something called cross multiplying. Okay, so when you cross multiply, you're going to take operating income and you're going to multiply it times, well, I'll show you here, times whatever's here. And what you have to assume is here is just 1. You know, if you put a line across this and then assume something, you have to assume that's a 1. So operating income times 1 is operating income, right? And then we'll also cross multiply the 18% times the $1,116,000. That'd be the second cross thing we'll cross multiply. And so when you multiply operating income times 1, you get operating income. And that operating income is equal to 18% times $1,116,000, which is the number we're going to come up with just a second, which is going to be $200,880. So I'm here to tell you that the answer is $200,880, but we're going to do something before we leave this problem. We're going to double check it. If we know this is the formula right here that we're going to use, we're going to do this. We're going to say $280,800, which is the operating income, divided by operating assets. And operating assets, we said, were $1,116,000. So if you take $200,880 divided by $1,116,000, you should get, and you will get, 18%. So it all checks out. We're all good. Let's go to the last question here. This is going to be like a homework question. It's like homework problem or exercise 15-8A, and it'll be on the exam. So here we go. Stewart Manufacturing Company established the following standard price and cost data. So our standard selling price is $8.60 a unit. Standard variable cost for manufacturing is $3.90 a unit. Standard fixed manufacturing cost is $2,500 total. And standard fixed selling and administrative cost is $700 total. So Stewart planned to produce and sell 2,500 units, but actual production and sales amounted to 2,700 units. So we sold and made 200 units more than what we planned to. Assuming that the actual sales price was $8.35 per unit and that the actual variable cost is $4.10 per unit, the actual fixed manufacturing cost were $2,000 and the actual selling and administrative costs were $740. They want you to determine flexible budget variances and classify the variances by selecting favorable with an F or unfavorable with a U, and select none if there's no effect, which would be no zero variance, right? So the first question you have to ask is, what should we use as a flexible budget unit number? Should we use 2,500 units? Should we use 2,700 units? That's really the first thing you need to do, and that's the key to the whole problem. And the answer here is, if you're operating under a flexible budget, you need to always use what you actually produced and sold, which was, in this case, 2,700 units. So 2,700 units, and then you're going to use that for the actual numbers that you come up with and the flexible budget. And then you're going to compare the flexible budget at 2,700 units to the actual budget that you actually achieve the numbers for actual cost. And that difference will be what your budget variances are. And they're going to be either favorable or unfavorable. So let's go to our first line here, which is sales. Sales are going to be a total of $23,220 under this flexible budget. And that number was arrived at by taking the standard cost for what we think, the standard selling price, what we think it should be, $8.60 times the flexible budget number of 2,700 units. That'll give us $23,220. Our variable manufacturing flexible budget number should be $10,530, which is based on a $3.90 standard variable cost times the actual level we produced at, which was 2,700 units. This gives us $10,530. Our contribution margin for this flexible budget will be the difference between the sales and the variable cost, which turns out to be $12,690. Fixed manufacturing will be based on what we have up here under the standard cost rules, which would be $2,500, right? Fixed selling and administrative will be $700. And when you combine all these pieces together, you'll get a net income under this flexible budget based on 2,700 units of $9,490. So it's real key to understand that you're going to use the 2,700 units to make this budget up. Now we're going to look at our actual expenses, again, based on 2,700 units. And here's our first number, which is sales. Excuse me, our actual sales are going to be $22,545, and that's based on the actual selling price, which was down here in the body of the problem, the actual selling price of $8.35 times this 2,700 units that we actually, had a volume for. So our total actual sales are $22,545. Next, we've got, we've got variable manufacturing actual expenses of $11,070, and that number was arrived at as follows. You took the actual variable cost that we had, which was $4.10 down here in the body of the problem, times the 2,700 units to get $11,070. Contribution margin would be the difference between sales and variable costs, which would be $11,475. Fixed manufacturing overhead will be $2,000, and that's based on the actual fixed manufacturing overhead of $2,000, right? And our fixed selling and administrative cost was $740, and that again, that's based on the actual amount we spent. And so this set of numbers comes out with a net income of $8,735. So now let's take a look at our flexible budget variances. Sales were supposed to be under this flexible budget $23,220. They actually ended up being $22,545, and that difference is going to be $675. And since the actual was more than the budget for sales, that's an unfavorable variance. I'm sorry, I said that wrong. Since the budgeted number of $23,220 was the higher number of the two between the budget number and the actual sales number, that's an unfavorable variance. Beg your pardon on that. Next, we've got variable manufacturing costs that were budgeted to be $10,530. They actually came out to be $11,070. So that's a higher number. So that cost is higher than it should be. So therefore, that's a $540 unfavorable variance. Contribution margin was supposed to be $12,690, came out to be $11,475. So that's a $1,215 variance, and it is unfavorable. Now, fixed manufacturing, that was supposed to be $2,500. It turned out to be $2,000, and that would be a variance of $500, and it is favorable because it turned out to be less than what we had budgeted for. Our fixed selling and administrative costs were supposed to be $700. They turned out to be $740. So that is a favorable variance of $40, right? I'm sorry, it's an unfavorable variance of $40 because the actual cost was more than the budgeted cost. You have to watch me on this. And then finally, our net income was budgeted to be $9,490. It actually turned out to be $8,735. And so that means that we have a variance of $755, and that's going to be unfavorable because this number was lower than what we budgeted for. Unfavorable. So that should be everything that you would see or expect to see on the exam. Do I have anything else here? Oh yes, we have another problem on the exam. It's exercise 15-13. I'm not going to go over that one. I repeat, I'm not going to go over that one, but you can watch the hint on that. There's a nice little video at the bottom of this exercise you can watch and rewatch, and it should be enough to help you understand how to work this problem on the exam. That's all I have.